Hi everyone, and welcome to the live trading session with OctaFX. My name is Ambrose Ebuka. You guys can go ahead and let me know in the comments if you can see me and hear me as well. Let me know in the comments, guys, if you can see me and hear me. Welcome to the live trading session with OctaFX. And again, my name is Ambrose Ebuka. And if you can see me and hear me, go ahead and let me know your name and where you're watching me from. You can also go ahead to tell me if this is your first time, participating in a live trading session with OctaFX. So in live trading sessions like this, we get to analyze some pairs and observe the volatility of the market and potentially take trades. And I believe that at the end of this live trading session, you all would learn something, one or two things about trading. And these things would also help in improving your trading abilities and help you create an edge or develop an edge that can keep you consistently profitable in the markets. In the course of this trading session, if you have questions, you can always go ahead and type it down so you don't forget. But towards the end of this trading session, we'll have a section for question and answer, and I can go ahead and answer all your questions. Once again, welcome. I'm going to check the comments to see if you guys... I just want to confirm if you guys can hear me. Okay. Basically, you guys can hear me. All right. Welcome again. Remember, if you have questions, you can go ahead and type them down, and we'll have a section where I can answer your questions. Let's just go through a quick disclaimer. Any opinion, news, research, prices, analysis, or other information discussed in this webinar or linked to this presentation are provided as general market commentary and do not constitute investment advice. Now, before we go ahead to analyze and take trades, I really want to emphasize on framework, and this is because we'll be using these steps or be implementing these steps while we are analyzing and identifying areas on our charts where we can take trades. Okay, you guys can hear me. Perfect. So we're going to go through this framework, and the first step under the framework is to check the economic calendar. Now, if you don't know what the framework does, it's basically the things you have to do before you execute a trade, right? So you don't just come into the market without analyzing or identifying areas where you can buy or sell, and you just come and start clicking buy and sell everywhere. There's a step and process to executing trades, and this would help you understand the areas of volatility that you can capitalize on as a Forex trader. So first, you want to check the economic calendar, and the reason for doing this is because economic events, news move currencies, right? The economic stability or instability of a country affects the domestic currency of that country. So let's say, for example, the United States, the unemployment rate is high, the economy is not doing so great. What happens to the currency? It depreciates in value, right? So that's why you always need to check the economic calendar so you know what news is going to be released today, the outcome of the news, how it's going to affect the domestic currency, and also so that you don't just place trades and a chairman of a central bank just comes on and says something about the currency and you're caught off guard, right? You always want to be working or trading in line with what's happening economically in a country. And the second thing, and I'll also show you guys, how you can get the news and read the news and also apply it to your trading. The second thing you want to do is to understand market structure. You want to identify key levels, identify areas where you'd execute these trades. And obviously, if you're executing a trade, you need to identify the areas where you want to exit that trade. And finally, before you execute the trade, you apply proper risk management strategies. So I'm just going to emphasize on it a little bit, and then we can dive right into the charts. Now, why should you understand market structure, or what is market structure? Market structure helps you understand and define the current market condition. This will give you buying or selling opportunities. Now, when you come into the market, just like the name goes, the structure of the market, you want to know if the market is in an uptrend. You want to know if the market is in a downtrend, right? You want to identify the direction of the market so that you can know if you should trade, with the trend, or you should be patient for a potential reversal. Just get a feel of the market. And you can identify the structure with the candlestick chart, which is mostly used charting type, the candlestick chart, and also chart patterns, trends and ranges, supply and demand zones, which I'm also going to, use and talk about while we are analyzing the charts today. And for your key levels, these are significant areas on your chart where markets can make retests rather. The market kind of moves like a magnet. So the areas where the market tests, or prices where the market tests, that it could potentially come to make a retest at that level, right? And you can identify these key levels using trend lines, moving average indicator, Fibonacci, and support and resistance. Guys, it's very important that you pay attention to this framework, because while I analyze, I'm going to be using a lot of these tools and a lot of this Forex, it's called jargons or terms, so that you can basically understand what I'm doing, so you're not confused. So that's for key levels. We use the trend lines, the moving average, the Fibonacci, and support and resistance to identify our key levels. And for entries, we want to get confirmation from candlesticks. And how do we do that? We look at the momentum of this candlestick, right? So I'll also show you guys how to read candlesticks, so you can identify a candlestick that has momentum and one that doesn't have momentum. And we can also identify entries using the moving average indicator as well. And for exits, like I said, when you identify areas where you want to execute a trade, you also need to identify areas where you want to exit that trade, right? You don't want to go into a trade and not know how to get out of the trade. And for your exits, you want to use swing highs and lows, which we're going to use as well. And would use automatic orders like stop loss and take profit orders, so that when you're on a vacation or you're out on a date or you're not just on your phone, the trade that you just placed can automatically close in profit or stop you from going further negative if the market moves against your direction. Okay, so you don't always have to be online for stop loss and take profit orders to execute. But you're also going to have to put your preferred price. I think I'll show you guys how to do that as well. And finally, risk management. Very important, because you want to identify how much you want to risk on that particular trade and your reward on that trade, right? An ideal risk would be 1 to 2% of your trading capital. And the reason for this is so that you can have more free margin to place more trades when you get an opportunity, and so that you can also stay in the market long enough to, make a profit. And we'd also use stop loss and take profit to also minimize our risk as well. These are automatic orders, like I explained earlier. And let me know in the chat if you guys are following so far, before I go into the economic calendar and we start to analyze. Let me know in the chat, guys, if you understand the framework. All right. All right. So we're going to come back to the candlestick, how to read a candlestick and, its constituents. But let me just show you guys how to analyze fundamentally, or how to get your economic news and economic reports, right? So you want to go to OctaFX.com. Right here, you can see that, and you come down to analysis and education. If you're using your mobile phone, it's going to be at the menu. I think it's at the top left, the navigation button, and then you come down to analytics, and economic calendar. So the economic calendar basically gives you an idea of the economic events happening and the reports, the actual reports, the forecast, and the previous reports, right? This is filtered to just high impact events, but I'm just going to add medium impact as well so that we can see the economic events that we had earlier today. Okay, now you can see it. So if you also want to stick to medium and high impact, you can just filter it here and make sure the date is the time zone is set to your country's time zone. And yeah, you can check economic events of yesterday, the previous week, the previous month, next month, and all that. So just use this economic calendar, play around with it, and try to understand, how to navigate around it. Now, when it comes down to understanding what they mean, so first, like I said, that's the first thing you want to do before you execute a trade, right? Before you go into the chart, you need to know what's going to happen today. So today we had quite a number of medium and high impact economic events relating to the US dollar, as you can see the indication here. And for you to understand what this basically means, you can see it here. Just click on it. You get the definition of every single economic event so you can understand what is being released and how you can capitalize. For example, generally speaking, and this is for the durable goods order except transportation. Generally speaking, a high reading is bullish for the USD while a low reading is seen as bearish, and we got a high reading, right? So that's basically how you can identify what's going on or what these economic events mean and how you can trade them as well. Now, we have one coming up, the Jackson Hole Symposium, that we're looking forward to as well. Give me a second, guys. All right. So basically, you're not going to just trade the fundamental or the economic reports in isolation. So I know I told you guys that when you come on here, you get the definition of what this means. And the reason you should actually understand what everything here means is because there are a lot of economic events that are happening. We have NFP, we have CPI, we have PMI. It's quite a lot. And we also have the FOMC meetings that happen 8 times a year. So you actually want to understand them as they are happening. That's actually one of the fastest way to understand it. So you can just click on each of these economic events and read here to understand it properly, right? And if you don't know what the Jackson Hole meeting is, it's a 2-day event that occurs annually in Jackson Hole. It's where a good number of specialists offer their forecast and basically their analysis of the United States economic and financial outlook. So you want to basically pay attention to these economic events because they impact the domestic currency. Let's say, for example, as the chair of the Fed, Jerome Powell is going to be present at this event, traders and investors are going to keep an eye out on what he says and try to identify his stance on monetary policy, and we can use that to apply to our technical analysis. If it's hawkish, if it's dovish, we can use that to apply to our technical analysis and potentially, capitalize on the direction of the market and direction of the domestic currency as well. So I believe that you guys are going to take advantage of this economic calendar. Okay, that's just a brief explanation of the economic calendar. We're going to move straight to the charts right now. Remember, guys, if you have questions, you can always ask in the chat, right? I'm constantly checking to see if you have questions, and when we get to the question and answer section, I'll go ahead and answer all your questions. All right, guys, before we go ahead and, analyze some pairs, would obviously take a look at the dollar index, right? Because we're trading major currency pairs, and we want to identify what's going on in the dollar index and use that as, or implement that across other major pairs or other major currencies that are paired with the US dollar. And if you have currency pairs that you want to analyze, or you want me to analyze, you can go ahead and type those currency pairs in the charts so that I can also look at them as well. All right. Now we can clearly see that the dollar index has been trending to the upside, right? We have this trend line here, and I mean, if you paid attention to the framework, you start to see some of the tools that I mentioned in play, right? So you see the identification of the key levels, the support and resistance levels. We're seeing let me just take this off so we can have a very clear chart. We're seeing the trend line, and you can see that this is a significant support trend line, because whenever the market bounced at this trend line, we had a push to the top side, right? We're seeing a number of, I think, 5 significant bounces on the trend line. And for every bounce, well, not really every bounce, but a good number of bounces on the trend line, you can see that it also aligns with our significant levels, our key levels, the support levels. You can see it here aligned with the support level. You can see this one as well, aligned with the support level. If I go to the lower time frame, I'll be able to draw some support levels here. But remember, you're not trading the dollar index, right? This is just for you to understand how the key levels work, how higher highs and higher lows are being created in the market, leading to an uptrend, right? So we're not trading the dollar index. I'll just show you guys an implementation of this on other pairs as well. Now we can clearly see the emergence of multiple higher highs and higher lows, and obviously the dollar index is in an uptrend, which means major currencies that are paired with the dollar would be in a downtrend, right? So if you check, let's say GBP USD, you can see that it's in a downtrend. Why? Because the dollar is strong, and obviously if the dollar is strong, we should be looking to buy the dollar. And if we're looking to buy the dollar on GBP USD, it means that we have to sell GBP to buy the dollar. I'm just going to take this off as well. So yeah, back to it. We have our most recent resistance level being broken through. We had a retest or a pushback into that level and a breakout as well. And now we are seeing the market test its most recent resistance level, right? Clearly, the dollar is in an uptrend. Clearly, the dollar is strong. But for us to actually be more confident in this uptrend and continue to buy the dollar across other pairs, we have to see a sustained break out of this previous resistance on the daily time frame. And the reason why we're using the daily time frame is because on the lower time frames, like let's say the 15 minutes time frame, the 1 hour time frame, you don't get to see a lot of overall data, right? It's like a lot of noise on the lower time frames, just like here. So on the 4 hour time frame, this wasn't really visible, but this is actually a resistance level. I think I'm going to indicate that as well for you guys. 1 second. Yeah. So we can see that the market tried to create a lower high here. You can see the lower high that was created, lower low. And the market tried but failed to create a excuse me guys, the market tried to create a lower high, failed to create that lower high, and broke above this previous lower high, leading to a break of structure. Now where are we heading? We're heading to the most recent resistance on the daily time frame, which is the 104.5 to 104.7 zone. And if we get to break past this, then we would clearly see that the dollar has gained more strength, and we're going to continue to buy the dollar on other, currency pairs or currencies that are paired with the US dollar, right? But for now, the dollar is still bullish. We're not seeing any signs of pullback. I'm just going to go to the 4-hour time frame. The dollar is pretty much bullish. We're seeing that it's also trying to break above this recent resistance on the 4-hour time frame. I need to indicate that as well, so you guys can see it properly. You can see that it's making a retest at this previous resistance. If it breaks above, then we're headed to the resistance on the daily time frame, which is this zone. Now, the idea with trading the dollar index, or analyzing the dollar index is that if it continues to be bullish, then pairs like GBP USD, you want to buy the dollar on those pairs, right? Pairs like Euro USD, you want to buy the dollar on those pairs. It just gives you an overall indication on the strength of the US dollar. But don't just go ahead buying the dollar across all pairs. You also want to look at the base currency. In this case, the base currency of GBP USD would be GBP, and you want to check what's going on economically as well. Check if there's going to be like a major impact event happening that day that you want to trade, because you could get caught up in fake outs. The market, USD could be strong, the market could be moving in a downtrend, but because there's an economic event that day, the market could just spike wildly up and down and continue to the downside. But at that time, you might be taken out of the market. Okay. So we have an idea of the dollar index now. We can clearly see that it's in an uptrend. The dollar is still bullish. We've not seen any signs of reversal. I mean, if you get, I have no idea why this is taking some time. Okay, let me just zoom in a bit. If we get something like this, and then we can start to brace up for a change in trajectory on the dollar index, right? But as long as we continue to trade above this significant trend line, let me also add the 200 period moving average as well, because the dollar index has started trading above it, right? So as long as we trade above this trend line and also above this 200 period moving average, then we're still bullish on the dollar. Okay, so now I believe that you guys can see the tools that I mentioned and that are included in our framework, come in play here. We have the moving average, as you can see, and what it basically does is it smoothens out price direction, right? So let's say we had something like this. So the moving average basically just shows you a smooth direction of the price, right? Without the noise, without all the noise. And also, you can use the moving average to identify entries, identify support levels as well. And by identifying entries, we can basically say rejections at the bounds of the moving average can give us, an idea of buying or selling entries. For example, let me go to the pound dollar chart and give you guys some examples. All right. So it's called the moving average bounce, actually. So the moving average bounce, you're basically trying to look for rejections at a test or a retest on the moving average, right? You want to see rejections like this. You want to see the markets reject like this. And this would have actually been beautiful trade because we had the market fake out, pull back in, make a retest at the moving average, and we are seeing the momentum candlestick as well push back to the downside. So that's another use of the moving average, and you can also use it to identify the trend. Like I said, if the market is trading above 200 period moving average, then that's clearly an uptrend. If it's trading below it, that's a downtrend. The market is moving in a downtrend. All right, let's look at gold. Remember, guys, if you want me to analyze any pairs, any of your favorite pairs, you can let me know in the chat. Just going to take this out for a second. All right, let's go to a clear chart. So if you guys remember the framework, you'd obviously recall that the second thing to do after identifying, after checking your economic calendar, the next thing you'd want to do is to understand market structure. Now, this is mostly for beginner traders. So when you come into the market and you start to see a lot of candlesticks like this and you see a lot of numbers, you start to get confused, right? That's why you need to have an understanding of the basic trends, basic support and resistance zone, basic candlesticks reading, to be able to identify momentum in the charts, to be able to understand the overall direction of the market. But here, what we're going to do is to first go to the higher time frames. And like I said, the higher time frame just gives you an overall direction of what's going on in the market, right? So you want to go to the higher time frames. I like to look at most recent price action. I don't really go back that far to like probably 3 years ago, 4 years ago. But if you want to obviously look at 4 years ago and 5 years ago, that's fine. That's if you're a swing trader and you want to, look at what's been going on back in time. Okay, so first, what we want to do is to identify the levels, the key levels, right? And the hint or the keynotes or the key thing you should do when identifying key levels is to not force the key levels to be there, right? Let's say, for example, I've just easily identified this support. So I'm not going to start trying to look for another support or resistance in the middle of this because I can't clearly see right now. If I probably go to the lower time frame, I can map out something there, but I'm just going to focus on the obvious, right? Just going to extend this a bit. So I'm going to focus on the obvious, which is this. Let's get another one. Struggling here a bit. I think I should extend this to this point here. Yeah. All right, guys. Remember, this is on the daily time frame, right? Except you're a swing trader, you like to hold your trades for weeks and probably months, then you can go for a lot of details on the daily time frame. But because I'm not looking to hold trades for weeks and months, I'd have to go to the 4-hour time frame to identify the key levels. So now we have our support and resistance levels, our supply and demand levels, and this is just basic price action strategies for everyone. So now we have this support and resistance levels mapped out. And we've also identified the direction of the market, which is an uptrend. We can see that the market is recovering from a downtrend. And this downtrend started in March. Uptrend switched to downtrend, and now we had the triple bottom rather. You can see the market made 3 retests at this support level, couldn't break below, pushed out above the neckline, made a retest, and started to rally to the top side. And why it's very important that you map out these zones is because they give you areas, or they kind of give you an idea of where the market is going to get back to. Remember, at the beginning, I told you guys that the market kind of moves like a magnet, right? So if it breaks out of this point, when it's coming back, where does it make a retest? It would most likely come down here to make a retest, just like this level as well. Breakout, make a retest. So if the market gets to break out of this zone, if it's pushing back, if it's making the correctional move, it comes back down to this point to make a retest, right? Just like you can see here, the market made a retest, pushed up, came back down to also make a retest at this point. And that's why it's very important that you map out your key levels. Now, if you do it on the higher time frame, it holds more depth on market price than on the lower time frame. So what I'm trying to say is you won't basically compare mapping out your support and resistance levels on a 15 minutes time frame to mapping out your support and resistance levels on a daily time frame. Daily time frame key levels are stronger, right? They would hold more than the 15 minutes time frames. So yeah, I'm just going to go to the 4-hour time frame. Let's look at most recent price action as well. Remember, guys, that's what I told you. So when if you get to the lower time frames, you can start to see some key levels or some minor key levels that you can also identify, and potentially expect the market to get to these levels. You see the rejections or you see the momentum at that level, and then you take your trades. So I'm just going to map this out quickly. All right. So what do you make out of this analysis? Now, we've identified the support and resistance levels. We've seen that the market is obviously creating lower highs and lower lows, moving in a downtrend. The market is also respecting this significant support trend line, bouncing off of it. And what happened here? So if I trace back to previous times, like June, 29 June of this year, you can see that the market came down to this point to create a support level at this point. I think that this also goes way back. I don't know, let's see. Okay, you can also see it here as well. And what happens? Kind of moves like a magnet. Came back here to make a retest. And you can see how there was a struggle at this point. The market failed to break below. I mean, obviously, if we had a break below this point, then that would have been a good indication of a continuous downtrend, and would have seen the prices of gold fall even lower to the downside. Let me just indicate this for you guys as well. So you can see how the market consolidated and tried to bounce off and break below this significant support level. Couldn't do that, and we started to push to the top side. Now, as we're pushing back up, what is the most recent area that price is going to test? Obviously, this, because this is the most recent swing high, right? this is the most recent swing high the market made before it started to push back down. On its way back up, it's going to make a retest at this zone. It's obviously headed there. You can see that it's kind of already there, but I don't want to drag this horizontal line down because we also have indications of volatility here. You see the market's made a test at this point, and the market hasn't gotten to that point yet. So I don't want to drag this down. I'm going to keep this where it is. And if you look closely, you can see that this also aligns with our 200 period moving average. So what happens when the market gets, let's say the market does something like this, and this is obviously what we would be looking out for on gold. I still expect gold to push to the top side, and then we can potentially start to see rejections that would bring gold down from this point. Okay, but I still expect gold to push to the upside, and then I'll be more observant of what happens here. So if we get a break above the 200 period moving average and also a break above this significant resistance, then we'll be bracing up for a change in direction on gold, potential recovery on gold in the coming weeks. Okay, but these are key levels that we're going to be paying attention to. I mean, we're almost at this one already. Let me check how many pips we are away from this one. We're about 80 pips. 80 pips away from this significant resistance level. Let me indicate that for you guys. So when I mean bounce, this is what I'm talking about. So if you observe the gold market, and this was in June, you can see that there was a rejection at this bounce. We want to see rejection candlesticks, right? If you look at, you're seeing a rejection candlestick here. You're seeing how the market is rejecting. The buyers have been rejected. There's a pullback. You can see it happen here as well. A test on the 200 period moving average. Don't break above. At this point, it broke above, and I'm also going to explain what happens when the market breaks above the 200 period moving average. So guys, remember, you're trading the bounce, right? Whenever it bounces, you want to see a rejection, and then you trade. You know, if it's a buy and there's a rejection from the sellers, then you can start to trade to the downside. But if you have a break out of that 200 period moving average, it's not really ideal to start going long because you want to see a follow-up. You want to see the candlestick. Let's say, for example, let me just zoom in a bit. Let's say we have this bullish candlestick that broke out of this 200 period moving average, right? You want to see the next candlestick also give you bullish momentum, right? And then you can use that as an indication that, okay, the buyers have successfully broken above, and we could be bracing up for an upward movement on gold. So you can see this is also previous resistance. Made a retest. Now we have the 200 period moving average here, but obviously the market tried to come here and make a retest. And if we had that break above this significant key level, then we could trade. We could have traded gold to the top side. And I believe that you guys can also learn something from this as well. And what you should learn is that you shouldn't trade indicators in isolation, right? So don't just trade with an indicator and say, well, the indicator, there's a break above, there's a bounce, and you just want to trade solely on the information the indicator gives you. And the indicator is like an extra confluence to whatever it is that is happening in the market, right? So you first need to understand price action, understand these key levels, identify them, and then if you had actually identified these key levels, then you'd be more patient to see what happens when the market gets to this point, rather than just trading off the bounce on the moving average. And that's why I indicated this key level here. And if you can see, it also aligns with our 200 period moving average. So if you get rejections at this point, and I start to see some, by rejections, I'm talking about bearish momentum candlesticks or doji candlesticks that show indecision, and then we could start to brace up for a temporal bearish move on gold. But if we don't see something like that, and we start to see more bullish momentum and breakout candlesticks and more bullish momentum, then we can start to brace up for an upward move on gold. Let me go lower and see if we have setups that we can find. Mm, 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 mm. So what I'm basically doing is to identify support and resistance levels. That's the one of the well, actually the first thing you want to do when you come on your charts. Okay, this can give you an in-depth detail on areas where the market can retest or areas where you can find buying and selling opportunities on a particular asset, right? In this case, we're looking at gold. Let's see. So remember, guys, we indicated this zone from the higher time frame as a significant resistance level where gold could potentially retest before we start to see rejections or breakouts of these zones, right? We're seeing the market make the impulsive move, and we're seeing it try to pause a bit before we get that continuous push to the top side or a break below to the downside. Let me highlight this zone for you guys. So I still expect gold to make a retest at 1925 to 1930 key levels, and that's because we've identified this on the higher time frame. We're seeing gold push further to the top side. A good place to take entries on this trade would be areas like here. We're already seeing the markets being rejected from this minor resistance level. You can see it made a test here, made a retest, and it's been rejected. So the market is beginning to pull back to the downside. So we'll be more comfortable to execute trades, buy trades, when we see the market reject here as well, or we see something like this, the rejection at this point, which is going to also align with our key level, this support here, and also align with the 200 period moving average on the lower time frame, right? Remember, we're expecting the market to get to this point, but we want to execute these trades at a comfortable price, okay? And I've just outlined an area where you guys can actually place buy trades on gold. But if we don't get to see rejections at this level, if we don't get to see the market pull back to this level and we see buying momentum or rejections and we see a break to the downside, then another place that we can also take buy trades would be areas like here as well, right? The significant trend line. But if we get a break below this significant trend line, then our bias would be null and void. Yeah. So we'll be looking to buy again on gold if gold gets to break below our significant support trend line and also this key level. So we'll be looking to buy gold again if we get that break and the follow up to the downside. Because what that would mean is that, let me just go to the 4-hour and show you guys. That would mean that gold just made a bounce at this 200 period moving average, the rejection, and basically made a lower high. You guys can see it here, right? So let me just check the Fibonacci as well. Yes, so basically our lines. Yeah, guys, we already seen the rejection, but remember, you want to be more comfortable to buy when the market pulls back into this zone on the lower time frame or into this significant support trend line. Yeah, you would have a retest and then you can start to catch the trades to the top side. But if you get a break below this significant support trend line and this minor key level here as well, then we'll start to look for sell trades on gold. All right, guys, let me know if you have questions in the comments. Let me know if you have questions. In the comments. I'm not really getting much volatility on gold right now. I want to see this candlestick close bearish first, and then we could scalp some sells on gold and get a nice 1-to-1. But I want to see this candlestick close bearish. Okay, let me check the comments and see. Please mention the price zone because I can't see it clearly with my phone. I'll just go ahead and indicate that for you guys. Give me a second. 1925 to 19, no, 1930. Make this a bit bold. So like I said, these are the areas where I expect gold to get to before we start to see a push to the downside. I expect gold to get to this point first and then start to see some rejections. Which of those level? Okay, this one here is 1912. And This is 1902 to 1905. So gold could push down to this 1912 level. It's going to align with this support that was just being created and tested twice but couldn't break below. It's also going to align with our 200 period moving average, and then we can anticipate some rejections and trade go to the top side, right? But if we break below this and have a sustained break, then we're coming down to 1902 to 1905 levels. So you can also take advantage of that as well and scalp about how many pips? 100 pips max from here. So I believe you got the zones now. I just indicated them on my charts. Let me know if you got it. When we spot price action pattern on like 15 minutes time frame, there are a lot of support and resistance zones. How do we signify the major zones? Really having issues with N3. Basically, I just showed you where you want to identify your major zones are on the daily time frame, right? And key levels, yeah, the 4-hour time frame as well. But on the daily time frame, that's where you want to identify your major support and resistance levels, identify the overall trend of the market, right? And then you can now start going to the 4-hour time frame to get your trend lines, identify some extra key levels as well. 15 minutes time frame, you're looking for candlestick momentum. So, and it also depends on your trading style. If you're a day trader, then you want to spend more time identifying your entries on the 15 minutes time frame, right? But you shouldn't neglect the higher time frames like the 4-hour time frame or the daily time frame. You shouldn't neglect those time frames because they give you an overall perspective of the trajectory of the market. Now, if you're a day trader, no, not day trader, if you're a swing trader, you want to hold the trades for a longer period of time, then you should be looking at the daily time frame and the 4-hour time frame for trade execution. But yeah, that's one way that you can actually signify the major zones. So when you come to the 15 minutes, you're already aware of the direction of the market. You just want to look for candlestick momentum and also probably identify some support and resistance levels as well, where market could just grab liquidity from and continue to the level that you already know. So you're not coming to the 15 minutes to say this is the direction of the market. You already know the direction from the higher time frames, and then you're going to the lower time frames for the lower time frame to tell you this is moving in line with the higher time frames. I don't know if you understand. So if the higher time frame is telling you uptrend, you want the 15 minutes to tell you uptrend, right? You want to place your trades where you're seeing the 15 minutes showing you, okay, I'm moving to an uptrend. So let me know if I answer the question. I think it's Jude that asked the question. Let me know if you understand now. And if you have extra questions, guys, I'm gonna take maybe one more question and then we can wrap up for today. All right. And you guys can also see that with this entry, the risk to reward here was, I think, about 1 to 1.2. So we're not doing 4% risk, 1% reward, or 5% risk, 1% reward. You have to keep your risk to reward at a very moderate level and also use a conservative lot size. Okay? Trading is not about being right all the time. It's about managing when you're wrong. Someone says no voice. Let me know if you guys can hear me. I believe I can hear myself. Let me know if you guys can hear me. I'll just take one more question. Someone's asking, how can one marry the fundamentals and technical indicators? So the fundamentals are there to give you, an idea of what's going on economically, right? The technicals are there to show you the areas on your charts where you should actually take these trades you want to take. So if the fundamentals are telling you go this strong, go this strong, you're looking at the next 1 week. You're looking at the next 2 weeks. Gold is going to be strong for the next 1 week and 2 weeks, right? I mean, the economy is great. Unemployment rate has reduced. Inflation is reduced. Economy is doing great, right? Which means the domestic currency is also going to do great. Now you have an idea of the direction of the market in the coming weeks. The technicals tell you areas where you should actually enter these trades in the direction of the fundamentals. That's why you have your key levels, your support and resistance levels, and you can take advantage of that. And it's actually very beautiful when you use the both of them. It's actually very beautiful when you use the both of them. Where would you advise someone who doesn't have any knowledge on the fundamental analysis to start from? Well, OctaFX has a lot of, on this YouTube channel, on the OctaFX official YouTube channel, there's a lot of educational videos regarding fundamental analysis that you can watch. You can also check the OctaFX website and the OctaFX trading app as well. There are trading articles that explains fundamental analysis. You can also check the OctaFX economic calendar, where you see that, like I said, you come to the market, you don't just want to go to the chart and start executing trades. You check economic calendar to see what's going on that day, and you learn as the day goes by. So let's say, for example, today we have NFP. You go to the economic calendar and check, what is NFP? What does it mean? How does it affect my trade? Now you've gotten an understanding, right, to an extent, but you already have an idea of what it does. So the next time you see NFP, you know what it does, you know how it affects your trade. You can improve your knowledge from there. But like I said, the YouTube channel, OctaFX, the economic calendar, and the trading app as well, where you can get educational articles. All right, guys, I'm going to wrap up now. We're going to have this live trading session next week, Thursday as well. I think on the 31st, yeah. So we're going to have this live trading session again, and I'll see you guys soon. Thank you for participating.